So how do you avoid the pitfalls when you inherit money? You think it might be all sunshine and roses when you inherit money, but there's some pitfalls that folks need to be aware of. So we're going to talk about that on the program today. Plus, we'll introduce you to the new debit card stimulus check. Yes, in fact, despite the IRS saying that they weren't going to do things that way, lo and behold, debit cards started showing up in people's mail. Plus, we thought this would be an important topic in today's world in light of such high unemployment numbers. Many of our listeners and family and friends are struggling to find work and have gone through a layoff. So we thought we would spend some time talking about some of the things that you can do if you've been laid off. So we'll cover all of that on the program. Thank you for listening in as our good friend Bud Hedinger aptly introduces the show. This is, of course, Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. You happen to be listening to the longest running radio program in Central Florida, one of the top 25 financial planning podcasts on the World Wide Web as well, and now on no less than 4 different stations in Central Florida. Happy to have, it's always been a part of the News Radio WFLA Orlando stations, but recently we have added in 96.9 The Game. So happy to now be on the Sports Network as well. So lots to talk about as we do each and every week. There's definitely, of course, a continuing sort of dichotomy, sort of a tale of two cities, if you will, between the markets and unemployment, because the unemployment numbers continue to grow, but yet the market continues to sort of percolate upwards. And you would think with all of these high unemployment numbers that you wouldn't expect the market to be responding positively. And maybe you haven't checked your balances lately. Maybe you're still working off your end of March statement, but the market certainly has improved pretty dramatically from those levels. At one point, it was down 34% since the beginning of the year. As of the time of the show, which is Thursday morning, the markets were down about 5% since the beginning of the year. So quite a bit of a shift. Meanwhile, the backdrop is that you've got much higher unemployment. The American public is clearly having to deal with these massive layoffs. And obviously we've talked about it in past programs, but just to kind of quickly recap why we think the market is behaving the way that it is, it's really kind of 3 things to be thinking about. First is the old expression of don't fight the Fed. When the Fed is lowering interest rates and putting a ton of money into the economic system, generally the market speaks positively to that. The second one is an old expression about you can't fight City Hall. And in this case, City Hall, Washington, D.C., they are literally putting in so much stimulus money into the economy as well. At last count, over $3 trillion with all of the different legislation that they've passed in relation to COVID. And then, of course, the reality of the markets themselves. Market indexes are somewhat dominated by technology, by financial services and healthcare. Those part of the sectors really haven't experienced the kind of massive disruption that we've seen, say, in the travel and leisure industry or in the restaurant sector. So definitely some reasons why the market is behaving the way that it is. Sort of a totally opposite picture when you go to the employment side of things. And so we certainly wanted to outline for our listeners some of the steps that they should be taking if they find themselves in the midst of the job layoffs that have just been happening in such massive numbers over the course of the past 6 or 7 weeks. And of course, the first thing you have to do if you're in that position is you've got to file unemployment. And I get it. You hear this horror stories of how long it takes and how difficult the process is. But folks, you kind of got to do that. I mean, that's sort of like your main job now when you get laid off, is to go through the process and be diligent on trying to get through the process of filing for unemployment. There's a lot of claims that have been approved and are getting paid, but there's also a lot that are kind of stuck in the mud. So treat that as your job, if you will. And ultimately, that's the most important thing, because there's certainly a lot of money at stake. Traditionally, the $275 per week, that's not that much. So in the CARES Act, what the folks in Washington did was they added $600 per week on top of that until July 31st. So the reality is that you've certainly got a tremendous opportunity to at least get some income in to help offset the devastation that many people are feeling as a result of these massive layoffs. So number one, you got to start with the unemployment process. Number two, fundamentally think about creating a budget. And maybe it's not necessarily a budget per se in the classic sense, but it really is sitting down and looking at the difference between your needs versus your wants. And I think that's a pretty significant difference, trying to sit down and list out all of those different things, because then you can start to see, okay, what do I really have to pay for here? What do I really have to worry about versus the things that might be more on the optional side of things or on the want side of things. And so what you have to do, obviously, when you lose your income is you have to cut expenses to the bare bones. And certainly that involves looking at all of the bills that come in on a regular basis, looking at the cable bill, for example, your cell phone bill, all of those bills, and see if there's ways to reduce down the amount of money that you're spending, and get down to that fundamental, what do I have to pay? What are my true needs versus my wants? So it requires that budget exercise that you want to go through if you've gone through a layoff. And then next up on the list is obviously the search for health insurance. You certainly don't want to be without health insurance. The cost is another factor that you're going to then have to kind of put into that budget, and may find yourself having to make some tough decisions on what that looks like. But you've got to factor it in if it's at all possible. Go to different sources for the plan. Maybe that's even exploring Obamacare. Maybe that's looking at COBRA, although those COBRA rates have a tendency to be high. But your next step sort of in the process, number one, you file for unemployment. Number two, you start to look at your expenses and determine needs versus wants. Next, you got to kind of take a look at that health insurance and how that is playing out as well, and how to determine where you're going to get that. And then certainly there's some other steps. I would say next up, once you've kind of gotten a handle on the needs versus wants, gone through that exercise, then it becomes an exercise of contacting your creditors, because that's where you're going to be able to start hopefully negotiating the process. I would encourage you to do that while you're sort of in good standing on it. If you've got a Fannie Mae mortgage, they're actually offering the ability to not have to make payments, either reduced or suspend altogether for up to 12 months. They're not forgiving the amount that you owe, but they are, in fact, at least not requiring to make those payments, and certainly to have those conversations with your other lenders as well. We've got some other things that we want you to also focus on when it comes to the steps you need to go through if you've been hit with a layoff. And we'll do that when we come back after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA and 93.9 The Game. Welcome back to the program, ladies and gentlemen. This is Dollars and Cents. I'm Joel Garris of Nelson Financial Planning. On the program today, we're talking about a tough issue that unfortunately many in America face today with these massive unemployment numbers, and sort of going through with you some of the things or some of the steps that you want to follow if you've been affected or your job has been affected as a result of all of this COVID pandemic. And it starts first with making sure that you are applying for unemployment. And we understand that that's such a process and just a headache-inducing one, but that's your job for now. And really stick with it and make sure that you're applying for unemployment, particularly with the extra $600 that the CARES Act added on to the weekly unemployment check between now and July 31. You certainly want to seek that out and to really try and get that unemployment as soon as possible. And then, of course, number two, you've got to look at kind of how you're spending your money, right? Your needs versus your wants. Strip things down to the bare essentials and really look at, okay, here are the things that I've got to pay for, and everything else sort of is adjustable. And that really requires a deeper dive into the things that you pay for. Maybe that's looking at your cell phone bill, your cable bill, or even those kinds of things, your car insurance, and really try and look for ways to reduce down what it is that you are spending on those typical bills. And then, of course, next up, once you kind of get a handle on kind of, the bills that are going out and what you have to pay for and what might be more optional, then it becomes a situation of looking at health insurance, right? I mean, you've got to continue to have health insurance. It's very, very costly. We know that, and so that becomes part of the budgetary items that you've got to look at in terms of making sure that you're able to cover, and also look at options. COBRA's one. COBRA has a tendency to be pretty expensive. Maybe that's Obamacare. Maybe that's looking at perhaps going on your spouse's plan. If your spouse perhaps is still working, maybe you shift over and go on their plan. And then sort of next up in sort of the steps is contacting your creditors. Look, you hear about these programs, particularly for Fannie Mae mortgages, that allow you to suspend or reduce your monthly payment. They're not going to give that to you automatically. You've got to contact them in order to be able to say, hey, I want to take advantage of whatever opportunity you're giving me to help reduce down the amount of money that I have to spend. Same thing true for your car loan or your credit cards. I think it's important to have those conversations when you're still in good standing, because you're in a little bit more of a better position, if you will. And so you certainly want to have those conversations initially, and if you're in the process of trying to negotiate how those payments. And all of this is tough. I mean, the cost of health insurance, negotiating with lenders, it's very difficult. But it's the old expression of, if your house is burning, I'm not sure you really want to spend the time to ask how much the water is costing to put the fire out. Clearly, there are some definite cost implications whenever you lose your job. And so the point of kind of sharing these things is to really kind of help give you a roadmap for what to do when you're confronted with a layoff. We've got a couple of more things to consider as well. And next up would be thinking of your retirement account, specifically your retirement account with your employer. So whether that's a 401k, a 403b, deferred comp, whatever the case may be. In the example of your traditional retirement plans like a 401k or a 403b, you've got some options that are broader than what they once were. The CARES Act really kind of expanded your ability to use your retirement dollars over the course of the next 3 years. You can pay the taxes on them, and in fact, you can even replace the money that you took out over the course of the next 3 years. So you've got a lot of flexibility to use your retirement dollars, more flexibility than you've ever had before. And so you can use up to $100,000 out of your retirement account. And as long as you put that back within the next 3 years, you don't pay any taxes on it. And if you're not able to put it back, then you can actually spread out the taxes over a 3-year period of time. The other part of it is that there's no 10% penalty for early withdrawal, which would typically apply. So a lot of options in terms of retirement accounts if you have to go that route. Obviously, we don't recommend that, but again, if you're trying to put a fire out, I'm not sure you stop and ask how much the water's costing. So, but just be aware that the cost of that water, particularly when it comes to a retirement account is much less and can be spread out over time. So definitely some things to be thinking about in terms of your retirement accounts with your employer and being able to access them. And similarly, an individual retirement account as well. One point or one tip on it, you may want to consider rolling over your 401k or 403b to an IRA if you're going to need to access that money, because the ability and the exceptions exist whether it's a 401k or a 403b or an IRA. But the IRA, you're not required to take out taxes on a mandatory basis. So if you take money from a 401k, typically they're mandated to withhold 20% for taxes. So that means if you need 10 grand, you're only going to wind up with 8. You've got to take more in order to get 10. If you do move the money over to an IRA, then you can set the tax withholding at 0, which gives you more flexibility to get the dollars that you actually need. And then lastly, of course, on to the job hunt, right? Putting your resume together and getting out there. Obviously, in today's world, the strength of your social media network or your family's social media network or your spouse's social media network becomes pretty important. Certainly, start there. It would be our suggestion, is to reach out to family, friends, acquaintances and see if they might have some job opportunities. And even if it is part-time for a period of time, any money coming in to help stem the flow is certainly a good idea in these times. So those are kind of sort of the six steps that we would encourage you to kind of follow if you've been hit with a layoff. So if you missed any of them, as you know, we take this broadcast, we convert it into a video that we put up on our YouTube channel. Our YouTube channel is Nelson Financial Planning. We encourage you to subscribe to our YouTube channel. And then, of course, we also convert this over to a podcast as well. And that podcast can be found on any of your favorite podcast providers, whether it's iTunes, Google Podcasts, Apple Play, any of those. You are available. You can find us simply by searching Nelson Financial Planning. If you can't find us, go to our website, nelsonfinancialplanning.com, and then in the upper right-hand corner of the website, you'll find a bunch of different icons. Click on the one that looks most familiar to you, and you'll get connected directly to our program. So we encourage you to subscribe to our YouTube channel and our podcast channels as well. So next up, despite what the IRS said they weren't going to do, they are now doing. And so starting this past week, they started mailing out debit cards instead of stimulus checks. So the IRS has really been all over the map on it. And we understand they've got 70,000 employees and they're all trying to work remotely. And it's amazing that they've been able to get out 140 million stimulus payments already. This current group, but that's not all. There's still more to come. This current group is the group that is about 4 million that is getting a debit card. And here's the crazy thing, you've got to be very careful. The debit card is basically showing up in an unmarked envelope. There's nothing that says Department of Treasury on it. There's nothing that says Internal Revenue Service on it. There's nothing to say that, hey, this is your stimulus check, debit card. So you've really got to watch your mail very carefully. It'd be all too easy to just throw out this debit card because there's nothing on it, the outside of the envelope, that makes you think that it is in fact your stimulus check. So there's some things that you've really got to look at when you're going through your mail to make sure you're not throwing away a debit card with $1,200 or $2,400 or more if you've got dependent children on it. So when we return to the program, we're going to tell you exactly what you need to look out for on that envelope so that you can make sure you're not throwing away your debit card from the IRS. All that coming up next on Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio, WFLA 93.9 The Game. Welcome back, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to us on any number of stations here in Central Florida. News Radio WFLA Orlando or 96.9 The Game. Welcome to the program. We're talking on the program today about the stimulus check that isn't really a check. It's a debit card. Despite what the IRS said that they weren't going to issue out debit cards, lo and behold, this past week they issued out debit cards to about 4 million Americans in basically unmarked envelopes. So we're going to tell you in this segment of the program exactly what you need to be looking for. If you haven't gotten your stimulus check yet, or you haven't gotten your stimulus deposit yet, and you're like, well, wait a minute, what else should I be looking for? Well, here's the next thing you should be looking for. It's a debit card in an unmarked envelope. Not totally unmarked, but it certainly doesn't say IRS or Department of Treasury on it. Here's what it says on it. So it arrives in a plain envelope with, I don't understand why they picked this, but it says on the outside of the envelope, the Money Network Cardholder Services. Okay? When you open it up, so on the outside, Money Network Cardholder Services, not the IRS. When you open it up, inside, it's a Visa debit card. The Visa name appears on the front. If you flip it over, the issuing bank is MetaBank. I don't even know who MetaBank is, but hey, okay, MetaBank. I also don't know who the Money Network Cardholder Services are, but again, these are the things you need to look for if you are getting if you're still waiting on your stimulus check. You may very well have had it arrive in the mail this past week in the form of a debit card. Much like any debit card, you've got to activate it. You've got to create a PIN. You can use it wherever Visa debit is accepted, or you can use it to get cash from an ATM. Again, anytime you're doing that, watch out for the fees. There's always kind of a dollar here, dollar there. The spending limit on the debit card is, of course, the amount of your stimulus check, and so just be aware that you're now getting that in the form of a debit check or debit card in basically an unmarked envelope. With the exception, though, that it does say the Money Network Cardholder Services, whoever that is. Issuing bank, MetaBank. Again, not really sure who that is, but hey, that's the latest on the check that has now become a debit card. While we're at it, let's debunk some of the other myths that are associated with the stimulus check. Donald Trump's name is on it, but he did not sign it. So if you get a check that's signed by Donald Trump, that's a fake. He did not sign it. His name is printed on it next to the Statue of Liberty, but Vona Robinson is the one who signed it. She's an official with the Treasury Department Bureau of Fiscal Services. She is the signer of the check. If you see Donald Trump's signature, that is not a valid check. So watch out for that. You do not need to file a return to get the check, but you may still be waiting to receive it. You can speed that up by going to the irs.gov website. Look for the section for non-filers to enter your payment information. So just because you didn't file a return, it doesn't undermine your eligibility for the check. It does appear that not filing a return does slow down your the speed with which you're getting the stimulus payment, but it doesn't make you ineligible on its face. Another common misconception on it is that it's going to be garnished for back taxes. The answer to that is absolutely not. It can potentially be garnished for child support, so that is one factor that comes into play, but not to be garnished for back taxes in any way, shape, or form. The stimulus check, the stimulus payment itself is tax-free. Don't have to report it as income, don't have to pay it back. If you didn't get it, and for this year, 2020, your income is such that you are eligible, then there will be some kind of a mechanism, form of some kind on your 2020 taxes that will allow you to get that if for some reason you didn't. If you're under age 17, you can get an extra $500 if you're dependent on someone else's tax return. If you're on someone's tax return, you're over 17, you're not going to get the extra $500. Similarly, if you're claiming as a dependent, your parent or what have you on it, again, not going to get that extra $500 because they're not under 17. Got to be under 17 to get that. And certainly not too late to get it. We saw just this past week where those debit cards were getting issued out to another 4 million Americans. 140 million is out, has been 140 million payments have been paid out. Still more to come. Unfortunately, folks in that group are generally folks that were the non-filers. If it doesn't show up and you were in fact eligible, meaning your income was below those thresholds of 75,000 as a single person, 150,000 as a married couple, and those obviously phase out up to 100,000 as a single person, 200,000 as a married couple. If you're in that category, you can certainly claim that on your 2020 return, but that may mean that you have to file a 2020 return in order to get it. And then lastly, and we've certainly talked about this on some prior shows, we had a number of dead clients get a stimulus check in front of a lot of people who were very much alive and looking for their stimulus check. And matter of fact, some of the stimulus payments that went to dead people were some of the very first ones that came out. And one of the first checks that we saw was actually to someone made payable to the name, and then after it said DECD, meaning clearly they were deceased and had passed away about a year prior. Anyway, you do have to return that money. They're not letting you keep that money. So just be aware, if you got a stimulus payment for someone who has passed, then you need to return that money. So just be aware of all of those different kind of factors and features that go into the stimulus payment. So certainly a bit of a moving target, to say the least, on all of this. And speaking of moving targets, one of the things that folks, kind of always kind of get, I guess, a bit of a double-edged sword, if you will, when someone receives an inheritance. And when you receive an inheritance, and you think it's all sunshine and rainbows, it's found money and all that. But the reality is that there are definitely some tax traps on it that you want to avoid, you need to be aware of, and you certainly want to avoid. And then, of course, the reality is if you're getting an inheritance, chances are that someone you love, family, friend, acquaintance, has passed on. So that's certainly kind of a double-edged sword on getting an inheritance, particularly then when you layer on some of the tax implications and other pitfalls that come with getting an inheritance. So we thought we would spend some time talking a little bit about that on the program as well, because there really are some pitfalls that folks that can be aware of. And I guess the first part of it is a kind of a crucial initial questions that you want to ask in the event of any inheriting of money. And the first one is, how is the distribution set up? Is this something that's going to come outright in a lump sum, or is it something that's going to be dispersed over time? Because you may have an ability to spread that out over time, or you may not have the ability and to spread it out over time. And so then that becomes pretty important to know what your options are in terms of receiving that money, because there's some tax implications on it. Certainly you may want to spread that out over a period of time rather than have those tax implications hit you all at once. And then the second sort of crucial question to be asking in the event of inheriting money is, okay, what's the tax nature of what I just inherited itself? Because then that's going to drive kind of the right way to approach this versus the wrong way? And so those are sort of the two initial crucial questions to ask when you inherit money. How's the distribution set out? Is it going to come out to me outright or over time? And then what's the tax nature of itself? In the next segment on the program, we're going to kind of dig a little bit deeper into the details of what that looks like when you inherit money. So stay tuned with us through the break. This is Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando, 96.9 The Game. Howdy friends, Dollars and Cents here. Central Florida's longest running radio program, also happens to be one of the top 25 financial planning podcasts on the World Wide Web. If you're interested in subscribing to our podcast or our YouTube channel, you can certainly simply search for us on your favorite podcast channel or social media network or YouTube itself by simply looking up Nelson Financial Planning and subscribing to us there. If you have trouble finding us, just go to our website, Nelson Financial Planning, and you'll see a bunch of different icons. Click on the one that looks most familiar to you, and you will get directed immediately to our podcast and YouTube channel. So we look forward to adding you as a subscriber in those formats. My name is Joel Garris of Nelson Financial Planning, and we're talking in this segment a little bit about some potential pitfalls when you inherit money. And most people say, well, if I inherit money, that's, all kind of sunshine and rainbows. That's found money. That's exciting stuff. But remember, it's a double-edged sword. I mean, the reality is that probably somebody you loved or was family, friends, acquaintance just passed away. That's kind of how an inheritance happens. So that's not necessarily a good thing. And then there's also some significant tax implications that you need to kind of really understand how that works. We saw just this past week somebody not really appreciating those tax consequences, and it wound up making a difference of over $20,000 on a $100,000 account for this particular person. Seems to me that if you're inheriting $100,000, you want the whole $100,000, not 80, right? And so that's why you have to be careful in terms of what you're doing when you inherit anything. And it starts with a couple of initial questions that we talked about in the last segment. Number one, how is that distribution coming to me? Is it coming to me in a lump sum, or is it coming to me over time? What options do I have in terms of the timing of receiving that money? And then, second of all, what's the tax nature of that money? And this is where we're going to spend some time in this segment really digging into that, because the tax nature is a big part of what the implications are going to be as you inherit that money. And basically, from a tax nature, you want to think of it as kind of two different categories. There's qualified money, which is basically thought of as retirement money, and then there is non-qualified money. And set aside how the money is invested, whether it's in mutual funds or stocks or bonds or real estate or annuities. Understand that fundamental difference between something that is qualified versus something that is non-qualified. On the qualified side of things, you have IRAs, you have 401ks, you have annuities that are invested in retirement accounts. You can have all kinds of those types of accounts. The bottom line is, if it's a retirement account of some nature, it is a qualified account. And so the next thing you have to be thinking about is, okay, well, are you the spouse of the person that passed away, or are you not the spouse? Because that then gives different options for you in terms of your ability to receive this money over time, or whether you can simply assume it as your own. Spouses have a lot more options in which to pick from, and in fact, the spouse, and only the spouse, has the option to assume the retirement account as their own. That's an option that is unique to spouses. If you're not the spouse, then the rules for distribution of that money have in fact changed pretty dramatically at the very beginning of this year under the Secures Act. We've long forgotten the Secures Act in the midst of all of this COVID crisis and the CARES Act and all that sort of stuff. But the Secure Act, which was passed at the beginning of the year, was pretty widespread in terms of its changes that it made to retirement accounts, and also the flexibility of beneficiaries to receive that money. And what the Secure Act did, besides increasing the required minimum distribution age from 70 and a half up to 72, it also wound up changing the option that beneficiaries had to spread out retirement distributions over the course of the rest of their lifetime. Now, they have to take it out over the course of a 10-year period of time. Again, spouses are unique. They can treat that as their own and ultimately spread that out over the rest of their lifetime. But a non-spouse beneficiary, now you've got to work sort of with that 10-year period of time. And it's so important to kind of understand that when you have these options, you've got to make sure that the paperwork is being done correctly. At no point in time when you inherit an IRA should you ever be taking that money and putting it into your own IRA. That will not work. That will be treated as a distribution. If you inherit a retirement account, you inherit an IRA, you inherit a 401k, you've got to set up an inherited or beneficiary IRA account that's going to have the name of the person who passed still on it as part of the registration. That's how to properly set it up to make sure that the tax implications don't hit all at once, to give you the flexibility to take that out over a period of time. Be very careful about doing lump sums because all of that is going to be taxable in a particular year. So just be aware, on the qualified side of things, traditionally retirement accounts, you've got some flexibility. You've got more flexibility if you're the spouse to assume that as your own. But if you're not the spouse, then you've got to be thinking, okay, what's the best strategy to take this out over a 10-year period of time? And here's a little nuance on that 10-year period of time. You don't have to take it out the same amount of money every 10 years. You can take 2 or 3 years off, but just know that you've got to take it all out over a 10-year period of time. There's not a requirement to take out a certain amount of dollars each and every year, as opposed to the old rules which said you've got to take out an amount each and every year in order to be legal on an inherited retirement account. So again, rules on that have changed a little bit, a lot, to be candid, and you certainly want to take the time to really understand that. Now, we talked about qualified money. Let's flip over to non-qualified money. So non-qualified money, three categories to really be thinking about. First, if it's a stock, if it's a property, if it's a mutual fund, those types of assets, there's something called the step-up in basis. And what that means is that if the folks that bought it only paid $10,000 and now the value is $20,000, then the step-up in basis means that now, for tax purposes, your basis is equal to the value at the time that that person passed. So that's very powerful. That basically means that you're going to be able to get that asset without any taxes. Similarly, life insurance. Life insurance, you don't have to worry about any taxes when you receive life insurance proceeds. So both of those, between the step up and life insurance, both of those would come to you without any tax implications. And then lastly, if it's an annuity that's not an IRA or qualified annuity, if it's a non-qualified annuity, know that the portion that is the profit, that's going to come to you with taxes. Once you get down to the original investment, then that comes without. So as you can see, depending upon kind of the nature of the type of account, depending upon the nature of the investment product, there's certainly some different tax implications on it. So we really encourage folks to really sit down and kind of go through these steps to really make sure that they are not creating a problem when they inherit money, that they're able to plan accordingly, plan properly, and make sure that they have all of their bases covered when it comes to inheriting money and minimizing the potential cost and tax implications on it. So certainly something to think about. We're going to get on out of here and wrap it on up. Thanks for listening on the end. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio, WFLA, and 96.9 The Game.